Welcome to Good Money Moves, the show where we share financial tips and advice to help you feel financially empowered. I'm Jenna, AVP of Marketing here at First Alliance Credit Union, and joining me today is Devang Patel, one of our lending advisors here at First Alliance Credit Union. Thank you so much for coming back and joining us. You were in another episode recently and did an amazing job sharing tons of information, and so I'm really glad to have you back. Before we dive into our very important topic today, which is credit scores and why they matter so much, what are they? We'll cover the gamut of credit scores across the board. But before we dig in, why don't you share a little bit about yourself and your role here at First Alliance?
So I am located at the Commerce Drive branch, and I'm a member lending advisor. So I do help a bunch of our members with auto loans, debt consolidations, credit cards, line of credit. So I know exactly how credit scores work, how they affect it, whether that's with loans or outside of loans. But I've been able to help a bunch of our members, especially those who think they might have really bad credit scores, even qualify for loans. So really able to help them out.
Yeah, so you're the perfect person to have here because you're looking at credit scores all day long.
Yep.
All day, every day.
All day long, every day.
Excellent. Well, let's dive right into this topic. So let's just start at the very beginning. What is a credit score really, and what does it represent about someone's financial behavior?
Of course. So a credit score in simple terms is basically, it's a 3-digit number that basically assesses an individual's ability to almost handle borrowed money. In simple terms, it just it goes over your risk profile.
Yeah.
So the higher your credit score is, the more likely that individual is to pay back any borrowed money. The lower the credit score is, the less likely, in a sense, or the more risky it is to give out that borrowed money to that individual.
Yeah, risky to the person lending the money.
To the person lending, yep.
Right.
It doesn't take into consideration any income or your character or anything like that. It just goes over, whether this person, considering their past behavior, not a future indicator, how they will handle their borrowed money.
Yeah. Mm-hmm. Excellent. So just to kind of summarize all of the information you shared, credit scores are a 3-digit number that financial institutions use to assess how risky it is or isn't to lend money to an individual.
Correct.
Okay, perfect. So let's talk a little bit about that 3-digit number. Mm-hmm. Is it better to have a higher number or a lower number?
It is 100% better to have a higher number. It ranges anywhere from 300 to 850. The higher you are, the more easier it will be when you're out trying to get a mortgage, trying to get an auto loan payment, an auto loan, a credit card, whatever it may be. Much easier when you have an 800 credit score. Lenders will look at it and be like, oh, perfect. This person has perfectly managed in the past any borrowed money he has taken out, or she. An individual who might have a 300 credit score could be someone who's had bankruptcies or collections or charge-offs. Basically what those are is saying a lender gave you borrowed money, you didn't pay us back. Mm-hmm. So 100% better to have a higher credit score.
Yeah, excellent. Thanks for clarifying that. So we kind of talked about this a little bit already, but essentially the credit score is used not just by lenders though, mm-hmm. right? It's also used often by landlords, utility companies will sometimes check your credit before, mm-hmm. employers will check your credit sometimes. So can you talk a little bit about why a credit score might matter in those scenarios?
Of course. So a nice example I like to give is, let's say you're trying to go out and grab a lease for an apartment. 2 individuals, both making the same income, both have the same situation, except one has a credit score of 760, one has a credit score of 620. The individual who has a credit score of 700 will probably be given just a normal 1 month security deposit as the only mandatory thing. An individual who has a 600 credit score will be probably required to have a cosigner or 3 months of security deposit or something like that.
Sure.
And depending on the market, that person may just get denied as well, okay. The one who has a 600 credit score.
Yeah.
So that is one instance on outside of loans, how it affects it. When it comes to utility companies, same thing with deposits. You might not expect it, but if you have a lower credit score, they might be like, hey, we just want to have 1 month of a deposit just in case. Mm-hmm. If you have a really good credit score, they won't require it at all.
Yeah. So it sounds like they're using it in similar ways to, a bank or a credit union in that way, that they're kind of using it as a reference point for, are you going to pay us on time?
Correct.
Yeah. Excellent. So that kind of leads me to the next question. We've talked about on-time payments as a factor of making up credit scores. What are some of the other factors that go into a credit score? Because it's more than just the payment itself.
Yep. So the payment history will be the biggest indicator of how your credit score is being affected. Another indicator is your credit utilization. So an advice I like to give to every single member I help, when you get a credit card, you have your credit limit. The credit limit basically is a dollar amount that states what you can use your card up to. So if we're doing a $2,000 credit card limit, I can use my credit card up to a limit of $2,000. However, if you do that, if you max it out, that means your utilization will be at 100%. The higher the utilization is, the more your credit score will drop, because it is showing lenders or the credit bureau that the amount of money that you are being offered, you're using it to its full extent, and that shows a bit risky behavior. If you're given $2,000, but you're only spending 10 to 30%, so anywhere from $200 to $600, and paying it off in full, it shows lenders he has the ability to use the $2,000. He's only using $200s. Do that for a while, and your credit score will increase. So credit utilization is one. A nice tip I also recently figured out is for every 1% increase in your credit utilization, there will be a 1-point decrease in your credit score. So that's a good little indicator.
Rule of thumb. Yeah, that's good advice.
Another thing that affects your credit score is your history. So just as long as you have some form of open revolving line, an auto or mortgage, something like that, however long your history is, that'll affect your credit score. So an individual who's only had a report of 1 year will be considered more riskier than someone who's had 20 years of an auto loan, a credit card, a mortgage, something like that, because you have an established history. Another thing is having various trade lines. So if you have an auto loan, if you have a mortgage, if you have a credit card, those are considered various different trade lines, and so those will help your credit score. Shows lenders that I can give him an auto, I can give him a house, I can give him a credit card. Doesn't matter, he'll pay me back on time. Or one of the biggest misconceptions individuals have is when they say different trade lines, people assume, oh, if I take out 10 different credit cards, that'll help. Don't do that. That does not mean like the more trade lines you have, the better. It means like you have a various types, not the same amount, multiple. So don't go out taking 10 credit cards at the same time.
Yeah. So if I'm hearing you right, when you hear the word trade line, it's not necessarily from different organizations. It's different types of credit, whether that's kind of a revolving credit, like a credit card or a line of credit, or something that's more of a fixed payment style, like a installment loan, auto loans, mortgages.
Correct.
They kind of look at those differently on the credit report.
Yep. And so I don't think it's a bad thing to have multiple credit cards. So if you have 2 to 3 credit cards, that's completely okay. Everyone has that. Obviously, different credit cards have different advantages, whether that's rewards, lower interest rates, or whatnot. But if in a short time frame you're taking out 10 credit cards, then it just shows lenders like, why is this individual taking out multiple different credit cards? Like, what is the purpose? Like, what does he need that for? So holding off on getting a bunch of credit cards would help.
Add them as you need them, not just to have them.
Correct.
Essentially. So we talked payment history, we talked longevity, so kind of how long you've had a credit profile factors into this. Credit utilization, so how much of your available credit are you using on a regular basis, and the number of trade lines factor into that. Did we miss anything when it comes to what makes up your credit score so far?
Nope. But once again, the biggest thing that will affect your credit score is your payment history. So keep in mind, let's say an individual has a 700 credit score and they miss one single payment. That can drop your credit score from anywhere to 60 to 100 points. One single missed payment. It doesn't matter if it's a $20 payment. It doesn't matter if it's a $2,000 payment. You miss one payment and gets reported to the credit bureau, it will drop it.
That's pretty significant.
It is very significant. So your payment history is the biggest indicator of your credit history.
Wow.
The utilization, you can affect it very quickly just by lowering your balances, paying it off. But your payment history will stay on there for quite a bit.
Yeah. So excellent information so far. I'm going to pivot our conversation just a little bit, and I want to talk about kind of the importance of building credit early on as a young adult. Like, why is it important to establish yourself with a credit score and a credit profile early on in life?
Yep. The main reason is because you will save a lot of money when it comes to interest. For anyone who doesn't know, interest is basically the additional money you're going to give to the lender or whoever it is for giving you that borrowed money. So if, let's say, you're fresh out of high school and you're going into college, I would suggest getting a beginner, just starting secured credit card or a normal $1,000, $2,000 limit credit card. Don't max it out. Start building that history. Once you're done with college, you'll have 4 years of history on your credit card. As long as you're making payments on time, keeping the balances low, your credit score will be in the high to mid 700s. Like, it'll be a good indicator. Now, let's say you're done with college, you don't have any sort of credit card, you don't have any history on your credit bureau. I'm assuming after college is done, or even during college, you'll need some sort of auto loan. You'll need some sort of car to get to work, to get to that. You go to a dealership and you say, hey, I'm trying to get a car. Because you have no credit, they don't have anything to assess how you handle money in the past. So what they will do is charge you a very high interest rate. You will qualify for a vehicle. It'll just be at a really high interest rate. So someone who has an 18% interest rate on their auto loan compared to a 4% will save hundreds, if not thousands of dollars over the lifespan of the loan that they're taking out.
Yeah. So the sooner you start to build that credit score and that credit profile for yourself, and you maintain and manage that your payments well, the better off you'll be in the long run, because your interest rate that's tied to your credit score impacts how much you're paying on those
100%.
payments, which can be very, very expensive at 18% plus, if higher than that for certain credit cards. So let me ask you this question. If someone has no credit profile, do they start at 300 and they have to build up to the 700, 800? Or do you start with nothing at all? Like, what does that actually mean?
Yep. So you actually start with nothing at all. It takes 6 months to establish a credit history of some sort. So if you were to take out a credit card right now, you would have to use it for at least 6 months. And then after that 6 months, you get a credit score. What most lenders typically see is that it is considered a false score, just because it was quickly just brought up. To make it an actual realistic score, it takes 2 years of history, at least 2 different sets of trade lines, or at least 4 different types of trade lines, and 2 years of history. And then that is what we consider like an actual score. Like, that is a true indicator. That does not mean like if you go out then that score just does not count or whatever. It still is a good indicator if it's after 6 months, but it does take 6 months to have some sort of score generate on your credit report.
And it's not enough just to have the credit card. You actually have to be using it and make payments for it to kind of count towards your credit score over that 6 months period.
Correct. So usually my recommendation is use your credit card, use 10% of it, let it hit the statement or whatever, and then pay it off in full. If for whatever reason you don't use the credit card for a month or 2 months, it is not a big deal. You just have to make sure that you're using it enough to the point where the card just doesn't close down. Because if you don't use the card for a long period of time, whoever the lender is will just close the card down, and it'll be considered a closed account on your credit report. So you just want to make sure it stays open, we're using it. And
So if you do end up with like a closed credit card or a closed trade line on your account, does that bring your credit score down then, because you're losing that history on that card or that loan that you had? So it can drop your score to let that happen.
Yep. So your history will be it will be calculated based on the average of your trade lines. So if you have a credit card from, let's say, the 1980 or something like that, and you close it down, your history will drop drastically, because then the average will be based off the next oldest trade line. So it is nice to always keep whatever your oldest credit card is, even if you're not going to use it, set up an automatic payment for like Netflix or Hulu, or just like, and then just use it on that. set up automatic payments just so it's $6. You're not using a crazy amount, and it'll stay open just because you're constantly using it.
Yeah, so you don't lose that history.
Correct.
Perfect. Well, that kind of actually is a good segue into my next question, and that is, so we've talked a little bit about what it looks like to start your credit score. What does it look like to rebuild it? Let's say you've, had a couple setbacks in life. Maybe you've had to go through collections, or worst case scenario, you had to file for bankruptcy. And now you're in a better position in life and you're trying to rebuild that score. What is that? Does that process look different? What are some other things to consider from that perspective?
What I will say is it definitely takes time. It won't be affected instantly. If you have collections, if you have charge-offs, if you have bankruptcy, it will stay on your credit report from anywhere from 7 to 10 years.
Okay.
It will be on there. That does not mean that you cannot increase your credit score. Once again, the biggest thing you have to do is, if you have a credit card, payment history. From that point on, your biggest thing is what you will do from now on in the future. Just keep making your payments on time. Don't abuse the credit card by maxing it out. If you have an auto loan, just once again, make your payments on time. Just continue that behavior and your credit score will slowly start to rise. If you're trying to qualify for, let's say you just recently had a bankruptcy or a collection and no one is willing to do a credit card or an unsecured credit card, what you can do is take out a secured credit card, meaning you will provide your own funds to lock up in an account that you can't touch, and then you can use the credit card. And oftentimes that is like a guarantee, like, yes, we will give you a credit card because you're putting up your own funds to use as collateral. So that is a great start. If you have $500 available after you recently just went through some tough times, just use that to open up a secured credit card. Spend the credit card, use the tips that I just mentioned, just 10% of it, pay it off in full at the end of every month. And after 6 months, after a year, you'll slowly start to see your credit score slowly go up and up and up. Good. And as time goes on, the collections and charge-offs and bankruptcy will take less of an effect because the history is just being pushed back.
Sure. That makes a ton of sense, and that's really great advice. We have talked about a ton of information, and I feel like we could just keep digging into this topic. There's so much to consider when it comes to credit scores and lending and borrowing and debt repayment and how all of that plays together. But we are about out of time, but I wanted to give you the opportunity to maybe just share a little, additional piece of advice that you want our listeners to know when it comes to managing their credit score today.
Managing the credit score, I would say one thing, keep an eye on it. I know our First Alliance app, if you have a different lender, what you can do is our app gives you a little soft score is what we say. So it is a good indicator, and it will show you on there how long your history is, what can you improve on your credit score, whether that's like reducing your utilization. You can manage it pretty well on there. It doesn't hurt to go on the app once a week and just check it. I guess once a month because it updates on a monthly basis. Just go in there, check what it is, see what's affecting it. But at the end of the day, it comes down to make your payments on time. Whoever it is, if you're struggling for whatever reason to make a payment, reach out to your lender. Your lender can oftentimes help you negotiate some of the terms or help you out in some way. We just want to make sure it doesn't hit that credit bureau or it doesn't hit your report because it will affect your credit score a lot. But biggest thing, keep your balances on your credit cards low. Don't max out your credit cards. Make payments on time, and you'll be off to a great start.
Awesome. Well, thank you so much. You've been, again, a font of knowledge. I'm so glad you joined us today, and thank you for joining us. This has been Good Money Moves, and make sure you like and subscribe so you never miss an episode. And if you want to learn more about credit cards and credit scores and debt and all of that stuff, check out our website, firstalliancecu.com, where you can learn more good money moves. And until next time, stay financially empowered.